What if I told you the next recession could be predicted by, drumrolls please, strippers? It sounds crazy, but there's actually some method to this madness. In fact, there's even a theory behind this, dubbed as the strippers index. So what exactly is the stripper index, and why should we pay attention to it? While it might sound like a joke to some, it's actually an interesting way to really understand how people's spending habits can signal early economic troubles. Here's the idea. The stripper index claims that if strippers who rely on cash tips in their line of work see significantly less money for an extended period of time, then the economy is experiencing strain. So it all comes down to discretionary income, which is the money people have left after paying for their essentials like rents, bills, and groceries. When the economy is shaky, people cut back on non-essentials like vacations, hobbies, and entertainment. So when people have less money to spend, going to a strip club isn't a priority anymore. So strippers rely heavily on cash tips. About 2/3 of their income comes from cash payments. So when the earnings drop, it's a sign that people are feeling the pinch, tightening their belts in preparation for leaner times. So why am I bringing this up on an investing channel? I know what you guys are thinking. Maybe it could have given me a legitimate reason to start researching about the adult entertainment industry. That might partly be one of the reasons, but it's not the main point. The main point, it's of course to help us bring the like button to the moon. So do help smash it if you've forgotten. Anyway, I think the most important question most investors and traders are asking today, where will the stock market be after this recent Fed cut? And it definitely doesn't help when you see graphs like these being spread like wildfire on social media, where they're basically trying to paint a picture that whenever the Fed pivots, i.e. starting to cut interest rates, the stock market, which is usually represented by the S&P 500 index, goes into a bear market territory. There are, however, quite a few nuances here. Although it seems like there is a strong relationship between Fed cuts and the US stock market going to a bear market, we need to be mindful of the differences between a correlation and a causation. While it's tempting to assume that every time the Fed cuts rate, a bear market follows, but it might not perfectly explain that it was the rate cut that caused the bear market. In reality, the Fed often cuts rates in response to economic weakness or an impending downturn. But here's the thing, it is also not true to assume that the stock market will fall whenever the Fed cuts its interest rates. So this table, tabulated by Provident, shows the total returns of both US small and large cap after the first rate cut, with data going back all the way to the 1970s. So they've tracked the returns of these stocks in varying time frames from the first rate cut, from 1 month to 5 years. And the data seems to vary in the short term, i.e. less than 6 months, but converge over the longer time frame. The determining factor is not so much whether the Fed had cut rates or not, but more so what happens to the economy after the rates were being brought down. So this research from Goldman Sachs shows that equities tend to perform well after the Fed cutting cycle starts, unless growth is weak. So as you follow the rate curve, equities are generally moving in an upward trajectory if there is no recession in most time periods after the first 2 months. Whereas for the light blue and orange curve, it shows the average return performance before and after 1990 in a recessionary environment. So pre-1990, it seems like equities would break even after 6 months or so. After 1990, on average, equities would break even after 24 months. So that's considering a recessionary period. So long story short, we just need to know whether the economy will enter into a recession. Which brings me back to this idea of a stripper index, which could potentially be some sort of a forward indicator, signaling a potential economic downturn. So just recently, I've came across a TikTok posted by this user, crazy_daisy, with not one once, not two once, but 5 ones. Crazy_daisy 11111. So let's see what she has to say.
So we've all heard that strippers are the first people to know when the economy is getting bad and there's a recession coming or whatever, because nobody's giving them business because they don't have any extra money like that, right? So as a hairstylist, I have my own theory. When girls start going natural or getting more lowlights, getting smudge roots, that's how we know. And it's not just because they don't have enough money for maintenance, but they also don't have enough time to come in the salon and get their highlights touched up every 4 weeks, because they're working or they're stressed or busy, like they don't have enough time for self-care. So yeah, I just saw this last night about like everybody now is old money blonde, which is just low maintenance blonde, stupid fucking name. But yeah, old money blonde, root smudge, natural color. Everybody looks better with their natural color. I disagree as a hairstylist, but I understand what you have to tell yourself when you really want to be blonde. But we're not making any money.
Now, her theory is simple. Other than strippers, hairstylists like herself are seeing signs of cracks as girls are no longer coming in for their treatment, and they're instead going natural. So she argued that it's not only because of the high cost of maintenance, but also because they don't have enough time to come into the salon every 4 weeks or so. So this is pretty interesting, especially to an Asian guy that cuts his hair for less than $8 per session. My brain probably cannot comprehend. On top of that, there is even this new hashtag movement, hashtag Recession Brunette, that came from this. After looking through the comments, I think there are two distinct groups. On the one hand, you really have people talking about being too poor to be a blonde. I can't even afford to get my nails done. I'm more concerned with affording for food. On the other hand, you have people complaining that the cost of services has just gone unreasonable for people. And some said they can't pay $500 every 4 weeks anymore because it's just so expensive. Whatever it is, I think we can agree that many consumers are now struggling with the rapid increase in cost of living over the past 3 years or so. Which then begs the question, what is the state of the economy today? So are we really in the early innings of a global recession? Regardless the indicator, whether it's the stripper index or the rise in style of recession brunette. Is it a reliable enough indicator for us to make any meaningful movements to our portfolio? Here's the bottom line. I really do hope that I can just order a crystal ball from Amazon that could tell me the future so that I can share that with you. But unfortunately, that's a fairy tale. So being able to make a case for predicting a future event with convincing stats and data points might sound attractive and fun, but the truth of the matter is, it usually doesn't pay well to consistently try to time in and out of the market. So remember the table tabulated by Provident? This is me making my case to you. Ignore the fluctuations in the short term, forget about all these talks about yield curve inversion, FOMC meeting, recession, etc. etc. Focus on staying invested for the long term, reap the market premium, and if history were to serve us as any guide, at least since the 1970s, 5 years after every rate cut cycle has seen the S&P 500 ending positive, with an average return of 89.7%. So that's something that I think pays pretty well, which also requires very little effort on your end to monitor and to time your entry and exit. And this is CK from Piranha Profit signing off. Till next time, keep winning.